Hi, everybody, and welcome back to video number 4 in chapter 14. When we left off, we were looking at the two acceptable methods of purchasing treasury stock. The cost method, of course, most widely used, and the par value method. Treasury stock, of course, reduces stockholders' equity. Let's take a look at an illustration. The Pacific Company issued 100,000 shares of dollar par value common stock at a price of $10 per share. In addition, it has retained earnings of $300,000, and we put that into the stockholders' equity section of the balance sheet as follows here, and away we go. Now, what happens if we acquire 10,000 shares of its stock at $11 per share? We're going to book the following journal entry by debiting treasury stock here for $110,000 and crediting cash to pay for it at $110,000. So now we've repurchased that stock with a basis of $11 per share. Now, here is how we would show that in the stockholders' equity section of the balance sheet. Pretty much everything down here is the same as we showed in the prior slide, but here you see a reduction of stockholders' equity for the cost of that treasury stock of $110,000. Pacific is going to subtract the cost of treasury stock from the total common stock, additional paid-in capital, and retained earnings. Treasury stock is a contra account, and it, of course, has a normal debit balance and therefore reduces stockholders' equity. Okay, we can acquire shares at our basis, above cost, below cost. I call that the basis. Both increase assets and stockholders' equity. Let's take a look. Here, we're selling back our treasury stock above cost. We originally acquired the 10,000 shares at $11. Now we're going to sell $1,000 of those at $15 a share, $4 more than what we paid for it. So how do we record that? We're going to debit cash for the full $15,000, and we'll credit treasury stock based on 1,000 shares times the basis of $11 or $11,000, and the remainder is a paid-in capital from treasury stock. And so I think that's pretty straightforward. Now, what happens if we sell an additional 1,000 shares, but this time at $8 per share, after we've made our $15 resale in the prior slide. So here we're only getting $8,000, $8 times 1,000 shares, and we have enough left over in paid-in capital, which is currently at $4,000, and we can reduce that by $3,000 here, and we reduce our treasury stock with a credit of $11,000 based on the $11 purchase of that. Okay, so now we only have $9,000 or 9,000 shares left from the 11,000 shares. Now we're going to show the T accounts here, and treasury stock is down to 88,000, and paid-in capital only has a balance of $1,000 now. We had to reduce that $4,000 by the $3,000 that we just did when we sold it at $8 a share. Now we're going to reduce it further here by selling an additional $1,000 at $8 a share, and we only have $1,000 balance in there. So what entry is it going to make to record the sale of that treasury shares and then how would you prepare the stockholders' equity section? Well, our journal entry, we're going to get another $8,000, but we only have $1,000 left in our paid-in capital from treasury stock. So we reduce it to zero here by $1,000, and then the remainder we put in retained earnings, $2,000 reduction. And again, we will credit treasury stock based on the original buyback price of $11. Okay, so now we only have 7,000 shares in the treasury, and we have our original $1 million here in capital stock, but our retained earnings has gone from 300,000 to 298,000 by a reduction here of $2,000 that we did here. And then finally, we have 77,000 left in the cost of our treasury, 7,000 shares times $11. And that leaves us with our total stockholders' equity of $1,221,000. Okay, now what happens if we retire the treasury stock? Here we're going to cancel the treasury stock, and that's going to reduce the number of shares of issued stock. So let's see how we do that. Here, in continuing with our Pacific example, we have 7,000 treasury shares left, and we're going to retire that. So we're going to retire it based on 7,000 at $1 par. There's our $7,000 here. And we have paid in capital in excess right now, $9 at 7,000 or 63,000. And that means our $7,000 remainder has to be pulled out of retained earnings. And the 77,000, which is the 7,000 shares times our original buyback cost of 11, gives us 77,000. So this $7,000 retained earning is the remainder after subtracting out our common stock. Everybody see that? A little tricky there. For home, sometimes though, depending on where Pacific incorporates, a state might require a debit or credit to paid in capital in excess of par and not to retain earnings when recording that retirement. But for our homework, let's use the approach we show here in this example. Okay, now here we have some transactions, and let's go through the first one on March 4th here. We issued 200,000 shares, $1 par value common stock for $1 million. So that one's pretty easy here. Debit cash for $1 million, credit common stock at par for 200,000 with a remainder to paid in capital in excess of par. On September 10th, we bought back 2,000 shares at $6 per share. Okay, so what we're going to do here is our cash is going to cost us 2,000 shares times $6 per share, or $12,000, and we debit contra equity account treasury stock for $12,000. Now we're going on October 15th, we're going to sell 1,000 of those back for $8 a share. So we made a couple of bucks on that per share on that one. And so we'll debit cash for $8,000. We'll credit paid in capital from treasury stock for the $2 per share, and the treasury stock for our basis here of $6 per share. Okay. Now, on November 20th, we retired the shares remaining in Treasury. Okay, and we want to prepare those entries using the cost method. So here, when we retire that, we have 1,000 shares remaining at $1 par, and here we have $4,000, which is the 1,000 shares, $5 less the $1, the same thing that we did here for $4,000. And then paid in capital from treasury stock is the $2,000 necessary to hit that total of retained earnings here, and then the $6,000 of treasury stock, which we still have remaining. Okay. Everybody see that? That last journal entry is a little tricky, so be sure you understand how to do that. Okay, now we're going to look at explaining the accounting and reporting issues related to dividends. Few companies pay dividends in amounts equal to their legally available retained earnings. Why is that? I think fairly obviously. They got to maintain agreements with creditors. They might need to meet state incorporation requirements to maintain certain levels of retained earnings, to retain assets or to finance growth or expansion, and number 4, to smooth out dividend payments, and lastly, number 5, to build up a cushion against possible losses. So, here's an illustration. Miracle Pod is a company that records daily podcasts. Its balance sheet, consisting only of recording equipment, is as follows. So here's its recording equipment, $500,000, and its capital stock is $400,000, and retained earnings is $100,000. Okay, so does the company have sufficient funds to pay dividends? Okay, Miracle Pod has a positive retained earnings. So unless they're restricted by, let's say, a bank covenant or something like that, it can declare a dividend up to $100,000. But because all of its assets or property, plant, and equipment are used in operations, the payment of a cash dividend would require the sale of its recording equipment or borrowing. So you can see the dilemma. Even if the balance sheet shows current assets as the following shows, the question remains as to whether the company needs its cash for other purposes. So here's cash of $100,000, recording equipment of $460,000. So our assets $560,000, current liabilities of $60,000, capital stock of $400,000, and retained earnings of $100,000. Balances at $560,000. So here, the existence of current liabilities strongly implies that Miracle Pod is going to need some of its cash to meet its current debts as the company matures. In addition, day-to-day cash requirements for payroll and other expenditures not included in current liabilities also require cash. Okay, dividend policy. A company should not pay a dividend unless both the present and future financial position warrant distribution. The SEC encourages companies to disclose their dividend policy in their annual report, especially those that, 1, have earnings but fail to pay dividends, or 2, do not expect to pay dividends in the foreseeable future. The SEC encourages companies that consistently pay dividends to indicate whether they intend to continue this practice in the future. This looks like a good place for us to stop this video, and when we return, we'll continue on with stockholders' equity. Until that time, bye for now.